Welcome back. In this video, we'll talk about Chapter 11. There's no mini exercise associated with this video, but let's get into it. In the previous chapter, we talked about some techniques to analyze potential projects, right? And those were based on forecast cash flows and forecast costs at time zero. So if you've got a cash flow timeline and a discount rate, you can find a project's net present value, see whether it's a good or a bad project, right? You can do internal rate of return, even payback period, right? And we took the cash flows as given. In this chapter, we're going to look more closely at what goes into the cash flows that end up on the cash flow timeline. Because in real life, there's quite a bit of work that goes into forecasting cash flows. This chapter just starts to scratch the surface of what's involved with that. So let's get into it. All right, we pretty much talked about these things. A couple things that we want to consider. First off is that we really want to discount cash flows. We don't want to put net income on a cash flow timeline, right? We don't want a stream of net income to discount to find the net present value. It can be misleading. And I would never give you a stream of forecast net incomes and ask you to find the net present value of those because that's kind of tricky. But this example might highlight why we want to use cash flow instead of net income. Remember, cash flow and net income can be really different things because of how accounting standards work. With accrual accounting, right, we recognize revenue in the period in which we make a sale as opposed to when we collect the cash. So it's possible to have a huge amount of sales but not be collecting any cash. So the cash flows can be a lot different from accounting profit. This project highlights that, right? Cost $2,000 at time zero, and then we've got future cash flows that are future cash inflows that are forecast. We can spread the expense of the cost over 2 years. We've got positive net income in one period and negative in another. Looks like a decent project, but we don't want to do this, right? We want to use cash flows. And if we forecast the cash flows and use cash flow measures on the cash flow timeline, this project is not a good project. And you can probably see that if you take a look at how much it costs, $2,000. And then you can see over the next 2 years, it generates total cash flows totaling $2,000. So with any positive discount rate, this project's going to have a negative NPV. So point one, discount cash flows. We want cash flows in the cash flow timeline. All right. Next thing we'll talk about is how to compute some of these cash flows and a couple different flavors, right? The amount we spend at time zero, forecasting how much a project will cost to get off the ground is, we could do a whole course in and of itself on estimating initial costs, but in the interest of time, let's not. How much money does it cost to get a project going? What assets do we need, and so on. We'll talk about computing free cash flows or a project's operating cash flows once it's up and running. And there may be some like wrap-up costs or wrap-up cash inflows. But let's focus on the operating cash flows for now. And if we have a forecast income statement, sometimes that's called a pro forma. Like pro forma means forecast. So if we have a forecast income statement for a project, it's pretty straightforward to compute operating cash flows based on income statement information. So EBIT, earnings before interest and taxes, plus depreciation, minus taxes. So these operating cash flows, some profitability measure, we add depreciation because depreciation is a non-cash expense, and then we subtract taxes because you pay taxes in cash. And then depreciation is a non-cash expense, but it has cash consequences because since it's an expense, it reduces taxable income. And here's the operating cash flow formula. So let's illustrate how to use it. Here's a little forecast income statement for a project, right? So if I could forecast a little income statement for a project, how much will the project generate in sales? What are the cost of goods sold associated with just that project? And then these other things. Then we can compute the project's operating cash flows, and it's pretty straightforward, especially if we have the formula in front of us, right? So in year one, operating cash flow would be equal to EBIT, 135, right? Plus depreciation, forecast to be 165, and then taxes, minus 47. All that math should come out to be 253 if we did the math right. In year two, operating cash flow is equal to EBIT plus depreciation, 140, minus taxes, 85. And if I've done the math right, that should come out to 299. So with a forecast income statement, hopefully computing the operating cash flows isn't too challenging. Now, the act of actually creating a forecast income statement for a brand new project, I could see it being pretty challenging. But for now, let's focus on the computation of the operating cash flows. So thanks for tuning into this video. In the next one, we'll talk more about the rest of chapter 11.